Welcome, everybody, to the Investopedia Advisor webinar series. Good to be back. It's been a while. This is our first one in a few weeks, and it is delightful to be with you. I'm super excited about this one. I'm Caleb Silver, the editor-in-chief of Investopedia. I love hosting these conversations. We have a very cool conversation in store today. We're going to be talking about how the world's largest asset managers are using blockchain today, but also where it's going. And I am delighted to be joined by Warren Pennington of Vanguard and Mark Smith of Symbian. You guys have a great story to tell. So let's get to the storytelling. We've got some slides to share, not too much. Let's make it more of a conversation because I think the history of how your companies have come together and what Vanguard is thinking when it comes to the blockchain and the problems that it solves and how you're helping them solve them are super fascinating for us. As always, folks, you can put your questions in the Q&A. You can save them for the last 10 minutes of the conversation. We'll go about 35 minutes or so, 40 minutes. Put your Q's and A's in there. If we don't get to them, we will get to them eventually. I will get to them. Warren will get to them. Mark will get to them. The three of us will somehow answer them. You can always email or just put them in the chat and we will get after it. But let's get after it ourselves right now. Let's start with you, Mark Smith of Symbian. Tell us who you are, tell us what Symbiont does, and then we'll get to Vanguard and how this relationship has come together.
Thanks, Caleb. Great to be here, and thanks to Investopedia, and welcome to all your listeners. We're excited to be the first one on your comeback, and really excited about talking what's happening in the blockchain space. Just real quickly, Mark Smith, I'm the co-founder and CEO of Symbiont. I'm a lifetime entrepreneur. Symbient's my sixth startup. All previous ones have gone from startup to exit, starting in matching, which changed the front office and trading of the world in finance. And now here we are again, changing the world and how we're going to create common market infrastructure using blockchain technology. And I'm so happy that my friend and colleague, Warren Pennington, is here to share the day with me.
Well, welcome, Warren. Let's unmute you to make sure we can hear you. Tell us what you do at Vanguard, and then we're going to get into this relationship. But welcome to the Advisor webinar series.
You bet, Caleb. Thanks for the opportunity to join, and good to be with you, Mark. So my name is Warren Pennington. I'm a principal at Vanguard in the investment management group, which is the part of Vanguard that manages all of the funds, basically takes the cash in and trades into the markets and helps run the funds the way we do. I head up a team that was formed a few years ago to do more exploratory R&D work, looking for things that could be disruptive over the horizon that align with Vanguard's investment philosophy and our outlook on the way we look at our clients.
Very cool. That must be a fun part of Vanguard to work in. So I'm going to share my screen with the bio so everybody knows who we are, who we're talking about here, because you know what you are doing particularly, Warren. And oops, are we seeing that? We're seeing probably not that. Hold on one sec. There we go. Is fascinating. Now let's talk about the relationship between Vanguard and Symbian, because it's not like you guys just got together over the last couple of years as cryptocurrencies have become so mainstream and taken off. This is a relationship that's 6 or so years old, 2016, which in blockchain years is like 600 years. So Warren, tell us how Symbian came to you and what problems you were looking to solve back at that time.
Yeah, that's great. It has been, you're right, it has been forever in the blockchain space to be working on this. But I think like many different firms and individuals back in the 2010s, by 2015, we had been interested on sort of how the market structure could be changed with blockchain. We got to learn a little bit about blockchain. Obviously, initial wind around Bitcoin and cryptocurrencies, early days. When we first got interested in it, again, the idea was to make the markets more efficient. So Vanguard is so large, and what we do is we take profits and we pass them through to our investors in the form of lower expenses. So we're constantly looking for ways to make things more efficient. And blockchain felt like a place that you could do that. If you know the mechanics of the markets and the way they work, there's just a lot of players involved. Just to do something very simple like to buy or sell a stock, for example. So we started to explore the space. We found some open source technology. We have a team of hands-on folks that were playing with that and learning more about it. And we came up with a thesis that said that we want to find somebody that's going to be aligned philosophically with our mission, which is to basically build a potentially revolutionary new way of looking at the way the markets work. So we looked at many different companies that were out in the space way back then. We also looked at open source, things like Hyperledger and other examples that were out there. But we landed on Mark's team at Symbiont because of three things. One is we felt that they had the right experience in capital markets. Mark's humble about his background, but all of that experience has been in capital markets. And then if you can go back in time, you can remember that, there's a lot of folks doing cryptocurrencies and blockchain that had no idea about how the markets work, and they were looking at different ways of doing it. The second was he also had tried to resist adding a bunch of Wall Street banks to his investor cap table, right? So the challenge with that is, the more of those folks you have on the cap table, the more you're going to perpetuate the status quo. And Vanguard's got a pretty good history of disrupting the status quo, everything from direct to consumer business model to the index fund itself, and the way we grew that. So that was really important to us. And the third was we just got really excited about their technology. We got in deep and worked directly with his key technologists and the team. And the technology itself just felt way better. There were a couple of different aspects of what that means, but simple things like the security, the fact that their blockchain was actually going to store data in the blockchain. There are a lot of shortcuts that other folks were taking that Mark and his team didn't take. So those three things helped us land on him as a strategic partner, and we've stayed there ever since.
Very cool. And Mark, you gave us a little briefer on Symbian, but the problems you were trying to solve back in 2016, cut to today to the problems you're trying to solve. Tell us a little bit about those.
Well, first of all, it warms my heart to hear Warren talk about the history, because, it's quite amazing that I think we were maybe 15 people when we first engaged with Vanguard. So to know that we both aligned in what I thought was the very most important thing at the time was philosophically. And we once we understood who we were and what each were trying to do, there was no question that for Symbiont, this was the right team to partner with and to explore how we're going to solve real problems. Because that's Symbiont's thesis, is that there are two types of things happening in this ecosystem. There's the crypto ecosystem, which is token economics. And that means that you're building economies, brand new economies. And those economies are being built around a token on a network. And then there's what Symbiont does, which is enterprise blockchain and smart contract technology, which isn't about building a new economy. It's about solving real problems in capital markets. So we also came together on that thesis, which is this is a tool to solve problems. And we can create some really exciting common market infrastructure here that can change how the markets operate for the next 50 years. And the idea that an asset manager like Vanguard would step into an opportunity, not only to just help themselves, but to change the market and take some of that risk to do these things, to build these new networks and this common market infrastructure so that their competitors will actually benefit. And, to me, I came from lava trading where coopetition was the core of what we did. And here we go again. Right now, I've got a partner that thinks about this in the same way, thinks about it from a compliance perspective, which is of the highest, most importance for Symbiont to be compliant so that we can deliver these solutions to our partners in a way in which they can feel comfortable using. And so the relationship started off small, and we incrementally started to identify areas where our technology matched what problems Vanguard wanted to solve. And so we began the process of working with a domain expert, defining problem sets, and then bespoke creating new solutions for them, and which has resulted in multiple products that have been launched. And the first product ever launched by an enterprise blockchain company and first product ever used by an asset manager, enterprise blockchain space, is a data product we developed with Vanguard, which we launched in February of 2019 and is growing all the time. And we're about to come out with version 2 of it this year and continue to expand it. So very exciting for us. Right partner, right idea. And I love the fact that Warren looked at the technology last, because really at the end of the day, that's how to look at it.
Yeah, you say compliance is what brought you together. I'm echoing somewhere, but compliance is what brought you together. Obviously very important for money managers, but get into that a little bit more, especially from your end, Warren, and why is that important? And why do financial advisors, a lot of whom are attending this, why do they care about that? Where do they see it on the back end?
Yeah, I think if I looked at it, that's one of the good parts about how we align, right? So we as a company, I think the ownership structure is pretty well known, but we're owned by our investors. It's a mutual ownership structure. that's not necessarily revolutionary. It's still unique in the asset management space. So we do have we have this interesting ability to start and finish with what is the client going to see, whether that's a financial advisor or the actual end investor client. And so while we're out there thinking about disruption and we're constantly looking to remove costs from the market, basically to get the investor to have a better chance of having more of their money in their pocket, right? We also want to minimize that risk, and compliance is probably the biggest area of risk, right? So we think that many of the smart regulations that are out there make a lot of sense. And so we just want to make sure that the one thing we don't do as we explore new technologies and we think about revolutionary business models is we don't break what's working already now, which is our clients have trust in the brand, their money is safe at Vanguard, the way we invest that money is very consistent and predictable, and you can count on Vanguard to constantly be shaving cost out. So that fund you bought 10 years ago, I'm pretty sure that expense ratio today is much lower, even if you didn't do anything. So staying true to that mission was really important. And that's why, there's kind of a large debate in the blockchain world about open source versus using a proprietary technology. But at the end of the day, what it really means is, are we more confident using something developed specially for this application, which is what Symbiont has done, or do we want to ride the open source approach and deal with that? And I think that we just felt like the one thing about the capital markets and finance is you tend to really like to know who's in there with you. So there's regulations about that, for example, know your customer and anti-money laundering. But basically the idea is just to keep a sense of who's in that space with you, who you're trading with, who you're dealing with. And we felt like this highly compliant, highly secure model that Symbiont has fits the current markets better. And I think it's a better model for the future as well. We're excited about what's going on in the wild west of cryptocurrencies. But for our core business, we wanted to stay safer and compliant.
Yeah, let's be clear. Vanguard is not about to offer me Bitcoin or Bitcoin futures or Ethereum, is it?
No, that's an easy one to answer. No, but that doesn't mean we aren't watching those developments and seeing what direction they're heading and making sure we're thinking about the long term.
Cool. I've been bouncing around this slide because I actually wanted to get a sense from you, Mark. Where do you fit into this slide, this big slide of a lot of these providers, or are you outside of this entire ecosystem?
So it looks like in this infographic, they put us right dead smack in the middle in capital markets alongside digital asset holdings and Clearmatics, who is actually now Finality, I believe. Trade Block, who is now Axoni.
Yeah, this is a few years old, so there's definitely been some movement here.
That's interesting. So look, I think that's fair. We are purpose built. Warren smartly said that we are purpose built. We were designed for capital markets. It was purposeful in our choices. And when we started building our assembly platform back in 2014, there were no other references except for Bitcoin itself. Ethereum hadn't even launched yet. So we were able to not be distracted by what was happening because it wasn't happening yet. And so because I come from capital markets, I said, look, guys, we're going to have to build something here that uses the best practices of institutional fintech. And I don't think many other blockchain companies approached it that way. They approached it by, oh, let's look at a reference of Ethereum. That must be the way to do it. We didn't have that. So we built something different, and it was purposeful. And so as Warren said, right, there were some key aspects of what we thought we had to do to be successful. Number one, it had to be secure. And not only secure, but it also had to provide for privacy and confidentiality. Institutional markets will not allow for anything that doesn't have the ability to create privacy and confidentiality in very sensitive financial transactions. And then you have to be able to store data. If you're going to have financial transactions, there is an auditable record that must be accessible. And I know a lot of blockchain providers say, well, we have a golden record, but the problem is that that's a golden record of hashes, but the data is held by a third party off the ledger that you now have to trust. So for us, it didn't make a lot of sense to build this great trust mousetrap and then leave it to get the real information. So we decided that our blockchain has to act like a distributed database and store data. And that created a very unique outcome for us that we weren't expecting. We thought others would make similar choices, and they just didn't. They just took the shortcuts of copying and cloning these open source networks and going from there. So I think that also helped us with Vanguard, because when we spoke about fintech, and we spoke about it as a fintech tool that solves problems. And we spoke about it in terms of what they were used to hearing, the ways in which fintech is developed, the importance of the security and how it's designed, and the importance of its functionality and reliability over long periods of time. So again, we just kept hitting the high notes with each other. And before we knew it, we were deeply embedded.
Yeah, well, good explanation. And this world has come a long way. Let's see if I can get to this other one. I like to share this when I talk about this in general. It's not that, again, Vanguard is not offering cryptocurrency right now, but in terms of blockchain applications across a variety of industries, this is happening. This is already a year or two old. There's probably 100 other firms that are using blockchain in some form for their businesses. So the fact that it's made its way to financial services, where it probably belongs the most, given the complexity of the data, I find to be the most fascinating. Let's talk about something very core to something advisors think about and individual investors think about a lot, which is the rebalancing of the index data. That's obviously massively complicated. We're talking about trillions and trillions of dollars, lots of transactions happening every single day. They got to be balanced every single day. Warren, from your perspective, why is blockchain and other applications like this helping you solve that problem? How do I feel it on the end as an investor or as a financial advisor?
Yeah. The answer to the end is we have to find the answer to say the end investor feels it through a lower cost or an improved performance. So in an index fund, performance is usually measured by tracking error, like keeping as close as you can to what that index says, even though the index is a hypothetical. An index doesn't trade, it doesn't hold cash, doesn't have to deal with a lot of the complexities that Vanguard and other asset managers have to deal with. So at the end of the day, for an index fund, we want to make sure we can make that operation more reliable and less costly. And so that's ultimately what we thought of. In context with our blockchain strategy, again, I sort of said from the beginning, what we felt like is the markets have gone from paper to electronic, sort of. Parts of it have, but the idea is digital. So the end goal is, we should be transforming towards a digital market, and we could talk more about that differently. But in order for us to get comfortable with that, we felt like we had to come up with a couple of phases. The first phase, we wanted to take the least amount of risk, and we wanted to not maybe touch the fund and maybe not touch money and not get into sort of highly regulated activities where the regulators weren't comfortable. So we looked at the way we do the rebalance. I'm back to your question. We looked at the way we do a rebalance, and you think about running an index fund, what it really is, at its simplest point, it's I have my index, which is, you consider it a shopping list. I have what I have in my fund, which is what I've got in my refrigerator, and I just need to figure out what I need to buy, and sometimes what I need to sell. So that is a very simplistic idea of what it is, but to do it well at scale is really hard. The other thing is that index data comes in, and whether it's right or wrong, it's right. In other words, whatever the index provider says is in the index, that's what it is. However, in reality, there are sometimes errors that are made. Maybe if a stock splits 4-for-1, the index provider's file might not reflect that right away. And meanwhile, the whole market has to deal with that. So, and the mechanism for them to correct that is pretty slow and outmoded. And the last piece would be like, what are index providers? They think of themselves, and they have been, strategically, they've been the ones that came up with a great index methodology. So most of the work went into what's the best index to have, like the justification. So the Dow Jones, everybody focuses on that. It's a price-weighted index. Most people think that doesn't make any sense. So the S&P says, let's do a capital-weighted index, a market cap-weighted, which is, weight the big companies the most. And that's felt better. And each different index provider comes up with a different methodology. That's a great investment strategy, and lots of people want to follow it. So they spend all this time and effort into that. And then when it comes to actually operationalizing it, which says, how can Vanguard run a fund that gives you the S&P 500 or the CRSP All World or whatever, that's kind of been a lower priority. So the mechanisms and the operations have not been as focused on, and they haven't been invested in. So technology in that space is really poorly developed. So we thought, let's go with, it's a model with a single source, sending it out to multiple subscribers. And sometimes those subscribers might want to send back and say, hey, I think you're wrong. So it's a two-way communication. It's kind of like a broadcast, but it's got two-way, and we want to make it really fast in real time. Well, blockchain is at its core a supercomputer that we all use at the same time. So it's as though we're all using the same computer and the same database, all at the same time. And that felt like a really good test case because we could get some real value out of it. If we could automate the way that index data comes in and some other things about how it's changing, well, if we could do that, then we've taken a lot of operational processes out, we've taken manual error out of it, we've sped it up, and we can get into the market faster. And what that allows us to do is to save a little cost on the operations and to keep tighter tracking error. So the end investor should see over time that we're getting more efficient and it's a high quality index fund. And frankly, the whole ecosystem can use that. So like Mark said earlier, like we solved it for ourselves, but anybody could take advantage of that. And there's other benefits there. So I hope that gives a decent explanation. And it's also the first stage of implementing blockchain, because one of the challenges, if you think about risk compliance, is this is a brand new technology with lots of esoteric ideas that people are uncomfortable with. You need to get people comfortable with that, and you need to prove it out. So the fact that it's been running in production since late 2019 is a real testament to that approach.
Yeah, we're in the first inning.
You're in the first inning. Yeah.
Maybe even the first third of the first inning of this entire rollout, even though it feels like it's been going on for a long time. But the application of the technology across this industry is just starting. But everybody says the financial industry, financial services, money management is where this belongs. Real estate too, maybe art collecting as well. So let's talk about how you scale this, Mark. This is, it was open, but also where else can this go? Let's not go nuts into other archaic investments, but across financial services, where do you think this technology makes a lot of sense?
Yeah, that's part of the key, is really having a good understanding and a strong thesis about the best and highest use of the technology and where it really fits, because it doesn't fit everywhere. And I think that was a problem with blockchain technology early on, was that all of a sudden it became the snake oil that fixed everything. And we always kind of scratched our head and said, why in the world are we going in this direction? No, this is a tool that will fix certain problems and won't fix others. And so I guess 6 years in, they must have been calling out the players on the schedule to play the game for the first 5, Warren, if we're still in inning number 1. So I'm happy if it's still inning
still in the
one.
national anthem.
There you go. We probably could have won in Vegas on the length of the national anthem, right? 6 years. Woo, we take the over on 3 minutes. So anyway, so scale is important, but I think what's more important is applying it in the right area. So Symbian developed a thesis very early on that said the best and highest use of this technology is to be at the genesis moment of the creation of that instrument. And it doesn't matter what that instrument is. In this case, it's a data block, right? Coming in from a data provider that we're manipulating, right? And so the best and highest use there at the origination, and then allow your smart contract technology, which is the supercomputer reference that Warren was making, execute the terms and conditions of that instrument. So in the case of data, it's, we're ordering it, we're getting rid of dupes, we're making sure things are correct, and we're preparing for trades to happen. And then allow the blockchain to custody that or to hold that information through its full life cycle to finality, even if that's in perpetuity, right? So that means infinite scale. If we ever find ourselves in equities and cash equities, you have to be able to manage it in perpetuity, right? We've got stocks now that are over 100 years old. So, so we then say, now what marketplaces are ripe for that type of deployment to create common market infrastructure? And those marketplaces are ones that are historically over the counter, that are already historically peer-to-peer, where I'm calling you and we're doing a bilateral trade, right? Or areas like data, where we have very complex structures. So for Symbiont, the more weird and complex and difficult the instrument, the better we do, because our very powerful smart contract technology was purposefully designed to create any arbitrarily complex instrument that the financial market may throw at you. So if you find the right market, and then you are able to create that instrument natively, and we're now back to the thesis that Warren was talking about, digital. And we're talking about digitally native, not something that's been bastardized from analog to digital, but actually originated on a digital way. Those are all the components that allow you to identify the right markets. And then in those markets, scale takes time. You try to avoid anything that requires low latency, high frequency, because that's not what distributed systems do. Physics won't allow a distributed system to perform like a centralized system. And we find that interesting because a lot of times people want to immediately go to performance of a blockchain to see if it scales or performs. And again, we scratch our head and we're like, well, what's the metric for performance here? Because transactions per second makes no sense, because what kind of transaction is it? What's in the package, right? Is it a token sending to one person with no return, or is it a huge data package to rebalance the S&P 500, right? I mean, so you really have to look more at how secure is it, how reliable is it, and how applicable is it to the marketplace you're deploying it, and really stay away from areas in which require that kind of low latency, because you're not going to succeed, and it's not going to perform the way you want it to, and it will not scale because of physics, right? You just can't have a distributed system go as fast as a centralized system. So we're not maximalists when it comes to decentralization, but we believe it's extremely important. It's a requirement over the long term. And we also believe that decentralization will scale, starting off with smaller networks that will get bigger over time as the will of the market shifts and starts to really believe in this technology and it takes hold.
Size, scale, security, better than speed in a situation like this.
Absolutely.
Folks, I see some questions coming in. Make sure you're hitting us up on the Q&A. We're going to get to as many as we can in our conversation. Warren, let me turn to you real quick on the regulatory front, because again, we're early in these days. This all seems obviously within bounds, but is there any impediments on the legal front, on the regulation front, that need to be moved or need to be adjusted in order for you and Vanguard to scale this the way you want to across other products, across other indexes, across other lines of business?
Yeah, it's a really good question. I think that what we see, so I would say no, it's not the critical step. It's not really slowing things down tremendously. Again, because we aren't focused on the actual Wild West of cryptocurrencies, we're focused on digitizing markets and opening up new asset classes over time. The benefit of a global footprint like Vanguard has is we can look around the world and see different regimes that are experimenting, exploring with how could they tailor their recommendations to do one of two things. And actually the state of Delaware, Mark had done some incredible work with state of Delaware, where most corporations are domiciled in the US anyway. But one of two things: either remove language that sounded like it tied certain things to paper, because that does exist, and that is a lot of the reason why we're at where we're at, or explicitly go and say, some sort of a digital record is adequate. So for example, in France, we worked with some folks there. The government and treasury decided that might be an interesting thing. It's almost like a competitive environment against London and other jurisdictions. They said, hey, for over-the-counter instruments, a record on blockchain is a legal custody record, and ownership is legally bound by that custody record. So they're very proactive. Asia's doing a lot of that as well. So I would say it's a great question. It is a concern in the long run, but I think it's not going to be the concern. I think the other things are around the incumbents, because right now, in order to work the way we want to work, like Mark said, with an over-the-counter trade, there's a question there we can get to later, but you have to have your counterparty be willing to work through the blockchain network, and we and our counterparties each need to have our custodian banks, or our bank, like whichever. Like for us, it's a custodian bank because the funds are all custody. So you got 4 players involved, right? And all 4 of them need to be ready to deal with this. So that's probably the bigger hurdle. And I don't think that the regulation is really going to slow us down there, again, because we're staying with recognized asset classes so far.
Cool. Let's take this first question from Samir, who's asking, did you have to have all of Vanguard's custodians agree to join the permission blockchain for this to be effective, or can investment managers use Assembly irrespective of custodians' participation? Good question.
So I'll go with that since it's a Vanguard question. So in general, I think I just answered it. Yeah, you need your custodians to be on board in some form or fashion if you're going to go down this path. And so that's why for us, the index data, there is no custodian involved. That's a pure operational process, got everybody used to it. The next phase is over-the-counter markets and probably what I would consider like a tokenization of assets or collateral. We can talk about smart collateral. Yep, you need your custodian bank to be there, and we're seeing a great deal of progress in that space as custodian banks are trying to figure out what they need to do to modernize their infrastructure, to squeeze out costs to make themselves more efficient, and also to recognize the growing demand by their clients, both retail and institutional, to figure out how to custody digital assets, like the real Wild West digital assets. So, so the short answer would have been yes.
Yeah.
They need
Does
to
that mean that you got to go on road shows and actually explain this to custodians, those that work with Vanguard or RIAs that work with Vanguard necessarily? How much of a learning tour are you having to do in order to make people aware of what's going on so that they're more comfortable with it?
Well, I would say so. Probably that's a yes, but the way we've approached it from the beginning is these are our partners, and all these operational changes involve our partners from the beginning. The good news was they were curious as well. Custodian banks and Vanguard probably don't have a tremendous degree of separation on our risk profile and our risk tolerance. I think they don't want to take much risk, and neither does Vanguard. So in some ways that's helped because, as a firm, when you think about what Vanguard's doing and if we're getting comfortable with it, there's some degree of reliance that, hey, probably that's not as risky as we might have thought. So it then becomes about like, okay, so which strategy do you want to follow when it comes to, okay, we're in with blockchain, we get it, we're going to go there someday, let's start doing it. Then you have to align on how you go about doing it, the actual execution.
Okay. Mark, as this obviously takes hold and grows and you're applying it more across what you're doing with Vanguard, I think you're working with other index providers as well. Crisp, I think you mentioned earlier on. But 5 years from now, what are we looking at in terms of financial services, the way blockchain is being used, and the way Symbian is playing into that, along with Vanguard or on its own? What does the world look like in 2027 if things progress the way that you'd like them to progress?
That's a great question, because I would have told you in 2014, by 2022, we would be substantially farther along with these networks and with these solutions. As Warren said, right, we solved data in 2019. We started knocking on the doors of custodians in 2015. We finally had a door open in 2021. So that'll tell you how hard it's been to really break through with the key constituents from the sell side that support asset managers like Vanguard. So we believe that a rising tide lifts all boats. And so as Bitcoin has come into favor, more people have turned their attention to Bitcoin and then to the technology, and then, okay, how do these things work and how do they solve problems? So we're very encouraged. We're also encouraged that a lot of new players are coming in the market that are digital first and are starting here and don't have legacy. So in 5 years, my hope is that some of those challengers have risen to the league tables and are starting to compete with the bigger players. And then I believe within 5 years, we'll have multiple networks in full operation with multiple large asset managers and their service providers participating. From an assembly perspective, we'll continue to transition from us building these sort of applications for everyone to those applications being available, and then the technology being in the hands of companies like Vanguard that can actually build these things on their own. Vanguard is becoming expert in building smart contracts with our language. And so part of this also is the removal of vendor lock and the ability for the first time for asset managers to innovate. They've historically had to take everything from a vendor or what the sell side had to offer. So new products are gonna be exposed, hopefully. I think the markets are gonna be substantially safer. This product that Warren sort of tipped his hand on with smart collateral, we just made a huge announcement. We did our first production transaction in smart collateral at the end of the year with State Street and Vanguard. So we're very excited about that. And the performance, 26 years as an entrepreneur inventing stuff in the back of a napkin. I think if you made me pick one product I've ever been associated with, it could have the most market impact, it'd be smart collateral. We, over multiple pilots and the production trade, we demonstrated an 80+% compression of counterparty risk. That's amazing. I mean, there is just, it's objectively changing the way in which collateral will be managed, the risk in which is taken when you enter into a bilateral transaction that has to be collateralized like an FX forward or swap. It'll change the way you think about counterparties. It'll change the way you think about the credit extended to those counterparties. And it will automate it so that it's deterministic and you never have to be concerned that there'll be any kind of manual errors or something that's human that causes the problem. So I think that product will be very, very, very large with a lot of users and trillions of dollars of collateral on that product in 5 years.
Is that simply because of the visibility and because of the decentralized nature of it and everybody can see what's going on? Is that what makes that the better application for collateral? Is that the value there?
That's part of it, but in this case, the smart contract and the way the smart contract can replace a lot of manual or scheduled functions in the back office, so that, you know, when you do your margin calculation and you agree upon that, both sides have to do the calculation. And we all know when you both sides do the calculation, they're not always the same. So now you have reconciliation. That then slows down how quick the collateral can move. The collateral movements are typically done overnight. So it's a day, maybe in some cases more than a day. With smart collateral, once you identify the collateral you're going to use, once your CSA that's digitized and lives natively on the blockchain and it has actually become dematerialized into a smart contract, that is a single calculation that will be done exactly the same every single time. And so we get determinism, and then we can gear that to as fast as we want. We've been going every 15 minutes. So now we can move that collateral every 15 minutes. And over the course of 30 days, you're moving the collateral a couple hundred times. And you can see the compression of risk, and you can see the market swing, and you can see where you sit from a collateral management perspective. So not only is it creating it be safer, we create more velocity with collateral. So now there's more efficiency for Vanguard and others. So you can use your collateral more effectively, which decreases your cost. And then you can find more counterparties to trade with. And maybe in 5 years, Vanguard will be able to trade with another asset manager directly without any intermediary, because you can accept their credit because of smart collateral. So it's really exciting what it could do.
And if I think
let me
about
ask
it,
you the same question, Warren.
yeah,
5 years from now, if this is working great, what's it mean for you?
yeah, I was going to say, if you think about it again from the investor or even the advisor and their client and what it means to them, I think what it means is that you're getting better prices, so higher performance, lower risk, so the cost of paying losses that generally you don't see, it's kind of opaque. You don't see it, but it's there. So again, you're making that more efficient. The markets are more stable and reliable, like Mark said. But I'd say, 5+ years out, one of the reasons why not all investors have the opportunity to invest the way that the big guys invest is just because of the way the markets work. It's just too complicated. There's too much risk. So if you think about everything from ancient times around lending or trading, collateral has always been a solution to help ease that, and you can increase the activity. So if you could take some sort of an interesting technology, smart collateral, and expose that and make it widely available, then suddenly I can remember The Big Short, the story about the background of like these guys were running around like crazy trying to get permission to trade, to make this big trade, and they couldn't do it because they weren't eligible, because they didn't have enough capital / collateral to do those trades. So different kinds of things become possible in the future. And I think that that's kind of our mission as a company, not to make it a Vanguard mission statement, but it is every investor having the opportunity to participate in the markets and get better returns and at a lower cost, full stop. So today, we're really efficient on these index funds and the equity markets, doing a great job in fixed income. We, as an institution, are really sophisticated, and we can do hedging, currency hedges, other things. We can trade derivatives. That helps the portfolio, which helps the end investor. But in the grand scheme of things, I think we want to keep pushing that out and making it more widespread and more available. we would benefit and everybody in the market benefits.
Well, I think that we could all agree with that. Vikram has a question, and it's not for either of you, but I'm going to take it because Vikram has been such a loyal guest to our advisor series, webinar series. He's asking the best way for asset managers to allocate to crypto or digital assets in their portfolios and gain exposure. Not for these guys. Vanguard doesn't offer it, and Symbian is a technology provider. But look at what's going on with some of these Bitcoin futures ETFs. Look what's going on at Grayscale. Look what's going on at Galaxy and the others. OnRamp is helping financial advisors get clients exposure to cryptocurrency. So tons going on in that world, just not for this combo, but I appreciate the question. And you're always such a good attendee, Vikram. So thank you. And thanks to you both. Learning a lot here, but I think, as I said, we're in early days here, even though you guys have been at this for quite a while and developed some really cool things. And I think you have a white paper. Do you have a white paper or something we could share? We'll share when we share the this recording so folks can get to it if they want, and send us any follow-up questions out there. We really appreciate your time and learning so much about this. Mark Smith of Symbian and Warren Pennington of Vanguard, thanks so much for being part of the Investopedia Advisor webinar series. Really delightful to have you here. Thanks to you all for attending. We'll catch you on the next one.
Thanks, Caleb and Vikram. Go buy, not investment advice. Galaxy Digital is a publicly traded company in Canada. They're one of our investors. So big time in all things crypto.
Yep. Plenty to learn there. Thanks so much, guys. And thanks to all of you.
Thank you.
And we'll see you next time.
Cheers.